Hello and welcome. If you're even thinking about buying a house in the US right now, it feels like you're stuck, right? On one hand, you've got these stubbornly high interest rates, but on the other, you can feel the market starting to change. So the big question is, what's the right move?
And that's really what we're going to dig into today. Is jumping into this market a brilliant move or a total financial headache? Well, let's stop guessing and actually follow the data to see what's going on.
All right, first things first. Before we can even talk about home prices or inventory, we have to look at the big picture. We need to understand the major economic forces that are really pulling the strings behind the scenes.
And this number right here, this is one of the most important signals for the housing market. It's the 10-year Treasury yield. Think of it as a benchmark that mortgage lenders watch like a hawk. When this number drops, mortgage rates usually follow, and as you can see, it just recently hit a pretty significant low. And sure enough, that drop had a direct, immediate impact. The average 30-year fixed mortgage rate dipped to 6.67%. Now, let's be clear, that is still high. But hey, in this climate, any little bit of downward movement is a really big deal. At the very same time, we're seeing other signs that the economy might be cooling off a bit. Continuing unemployment claims are hanging out just under 2 million. Now, this is a number the Federal Reserve is watching very, very closely as it decides what to do next with interest rates. And trust me, everyone in real estate is waiting for that decision.
Okay, so that's the economic backdrop. Now let's get to the good stuff. How are these signals actually hitting the national housing market? How are real buyers and sellers reacting to all this?
Well, the reaction was fast. The second those rates ticked down, mortgage applications shot up. But the real story here, the headline, is that refinance number, a massive 23% spike in just 1 week.
And you don't have to take my word for it. This quote from Joel Kahn over at the Mortgage Bankers Association lays it out perfectly. He's confirming that even that small dip in rates was enough to just unleash this wave of pent-up demand, especially from homeowners who've been waiting to refinance.
So you might be asking, why are so many people refinancing right now? Well, it all comes down to this term, loan-to-value, or LTV. You see, because home values went up so much over the last few years, a lot of homeowners are sitting on a mountain of equity. This lowers their LTV ratio, which makes them a perfect candidate to get a much better rate on a refi.
Okay, now let's switch over to home sales. This is where it gets interesting. In July, sales actually beat what everyone was expecting, which was a nice little surprise. But, and this is a huge but, you have to understand that the overall pace of sales is still incredibly slow. I mean, we're talking lower than during the 2008 recession. So it's a small win in a very, very sluggish market.
And check this out. This is a fascinating piece of the puzzle. 31% of all home purchases in July were made with cash. To give you some perspective, that's more than double the 13% we saw just the previous year. It just goes to show how much these high interest rates are pushing regular, finance buyers to the sidelines, leaving the field wide open for people who can pay in cash.
To really see how all these trends are playing out on the ground, let's zoom in. We're going to do a deep dive into the California market, which is often a bellwether for what's happening across the entire country.
Okay, the data here paints a really clear picture. You can see prices are down, just a little, but they're down. Sales volume, that's down over 4%. And at the same time, inventory is up, and look at this. Homes are sitting on the market for an extra 8 days compared to last year. If you're a buyer, all of these are signals that the power dynamic is starting to shift in your favor. The market is definitely slowing down.
And there's this really unique thing happening right now, especially at the entry-level price point, what we're calling the inherited property problem. You've got these homes that are often pretty dated, they need a ton of work, and that can really scare off first-time buyers who just don't have a big budget for renovations. And the result of that? Well, these properties tend to sit on the market longer, which creates a whole lot more room for price negotiation and for getting sellers to offer concessions.
So, with all this going on, where are we headed? Let's take a quick look at the key factors that are really going to shape mortgage rates and the overall market in the next few months.
Here you go. This is basically your cheat sheet. You're going to want to keep an eye on any geopolitical events, listen really closely to what the Fed says, a rate cut is pretty widely expected in September, and of course, watch that 10-year Treasury yield. If that thing drops below 4.2%, we could see mortgage rates get a lot closer to that 6% mark.
All right, we've covered the economy, we've gone through the market data, now for the most important part. What on earth does this all mean for you? This is your playbook for how to handle today's market.
And this brings us to something that people so often forget. Even with today's higher rates, negotiating a lower purchase price gives you a benefit that lasts forever. Lower property taxes. Seriously, in states like California, your property tax base gets locked in the day you buy. So a discount today doesn't just save you money up front, it literally saves you money every single year for as long as you own that home.
So if you're even kind of thinking about buying, this is your homework. This is what you should be doing right now. Get that credit score as high as you possibly can. Make sure your income is stable and well documented. And have your down payment funds ready and accessible. Being prepared is absolutely key to being able to jump on an opportunity when you see one.
And all of this leads us to the core strategy for this market. Right now, the insane bidding wars are mostly on pause. Negotiation is actually possible again. So the play is this: buy now, lock in a better price while there's less competition, and then plan to refinance into a lower rate mortgage once rates eventually come down.
So we end up right back where we started, but hopefully with a lot more clarity. Look, everybody knows that when interest rates fall, the competition is going to come roaring back, and prices will almost certainly shoot up again. So the real question you have to ask yourself is this: what's the bigger risk? Is it paying a higher interest rate for a little while, or is it missing this very rare, maybe temporary window of opportunity to actually negotiate a better price on the house itself?